Yo, what's good? Welcome back to another great video. Today we are going to cover Success in Sight, Volume 2. This is part of a 7-book series, the Royalty FX Academy collection. Now, this book right here it is dedicated to those traders that need a little bit of assistance when it comes to understanding market structure, trend lines, Fibonacci retracement, how to mark their zones, and also for those that are interested in trading but do not have the time to be in the Zoom calls or be on YouTube for a long period of time. This is a hands-on book. This is also dedicated to those that do extremely well when it comes to hands-on, having the book in front of their hand. This book right here is a 60-day challenge workbook that covers everything that you need to understand about the forex market, a selling market, a bearish market to be very specific, right? So everything that you need to understand is going to be in this book. Not a lot of reading, just work, tracing over the dotted line, and then market it on your own. 60-day challenge, understanding the market structure, fib retracement, understanding the lower lows and the lower highs when it comes to a bearish market. This book will help you out. I guarantee you, after your 60-day of locking in, by the time you finish this book, you will understand all the ins and outs about the forex market as far as market structure. So with that being said, let us go ahead and hit the chart and put in some work. So first thing, bearish market, right? Bearish market. So a bearish market is also considered as a selling market. Okay. A bearish market is also considered as a selling market, also considered as a downtrend market. Okay. Okay. It's also considered as a downtrend market, also a fallen market. These are just different terminologies to let you know that the market is going down. And when it comes to a downtrend market or a bearish market, you will look for structures such as lower highs and lower lows. Okay. So I'm running one more time. So a bearish market is also considered as a selling market, is when the market is falling down. It was coming down. Okay. Now, with that being said, when you're looking at the chart, you're identifying the trend, the overall trend of the market. You want to look at the structure that the market is giving you. That way it helps you understand where the market is going. Since we are talking about a selling market, a downtrend market or a bearish market will consist of lower lows and lower highs, right? Where each high is lower than the previous one. That's why it's called a lower high. And also where each low is lower than the previous one. That's why it's called a lower low, right? So let me go ahead and draw out a downtrend. And then we're going to place in the structure itself for it, right? So this is a bearish market that's fallen, that's giving you lower lows and lower highs. Okay. Now, this is a downtrend market. In a downtrend market, you're looking at the points. Okay. These points are the turnaround point. These are the turnaround points. By identifying the turnaround points, it helps you understand where the market is going and where is your next trade going to come from. Now, with this, here is a low high. When the market falls, it gives you a lower low because the previous low point, right? The previous lower low point got broken. Market broke through that low, stops here, go up. At this point, this is a lower low, and the market goes up. And then the fall like so. Now you have lower highs. So these are lower highs, right? If you pay attention, you notice how each high point is getting lower than the previous low point, right? It's going to keep on getting lower and lower. So each low is going to get lower, right? Same thing with the lower high. Now with the lower low, same concept. You notice that each low is getting lower than the previous low. Okay. So one more time, in a bearish market, when you're looking at the overall trend, you looking to understand market structure itself to see where the market is going. In the case of this, you see how the market gives you lower lows and lower high, where each low is getting lower than the previous low and each high is getting lower than the previous high. Okay. Now let's go ahead and do a clear markdown real quick. So we're going to go ahead and do a different trend where market gives you small infrastructure as it falls and buys. Okay. And then to go up, because not all the time you're going to get a clean structure that just go up. Okay. Sometimes it will do this and then the fall. All right. Like so. Now it's the same concept where this is a lower low, another lower low, because this one is lower than the previous low. And next structure point is a lower low, where each low is lower than the previous point. Now, one thing I want to make very clear, when we're looking at these structures, again, we are looking at the higher time frame. When we want to understand the overall trend of the market, when we want to take a trade, we want to see and understand where is the market going. Now, this downtrend, we are looking at this. Okay, we are looking at this in the monthly time frame. For the higher time frames, monthly, weekly, and then daily. These are your higher time frame to identify overall trend of the market before you decide if you're going to buy the market or sell the market itself. All right. Now, of course, when it comes to taking our trade, it's going to be the 4 hours. So we're going to go ahead and go over that also. Now, back to this, where each low is lower than the previous low. Now, these right here are lower highs. Okay. If you pay attention, each high is lower than the previous high. Now, we know market give us a lot of small infrastructure in between it. These are the infrastructures you would get in the 4 hour time frame, the 1 hour, 30-minute, 15-minute or less. Okay. We don't want to get fooled by these type of structures, understanding, oh, now market is now in a bullish trend or the trend had reversed. Now, I'm not saying that this is not a bullish trend, but this is just a retracement for the market to go ahead and give you the correction to continue back down. Just like here, market consolidate here, right? This is the same level. Those two are lower lows, right? It's pretty much the same zone, same low point. Now, market did buy up. Yeah, it is a bullish trend, but on the overall, the bigger picture, the bigger scheme of it, it is a bearish market. Okay. So it's simply buying to retest a specific level to come back up. Normally, when the market itself leaves a lower low point to go up, you look at the previous low structure that the market gives you for it to be the retest point. Now, it's not always going to be that one, but this is typically where it would go, so on and so forth. Sometimes it does go a little bit higher than it, but that's just the general idea. Okay. Now, again, you notice how each low is lower than the previous low. So that is the general aspect of a downtrend when it comes to market structure itself. This is what we have in this book. Now, what I'm going to do is I'm going to go more in depth as far as the break and retest point where you would enter and what does these points mean, right? What do they mean? And also, when it comes to a downtrend, where are we looking to take our trade? So let's go ahead and throw that in there real quick. Let's go ahead and pick up to that. So we understand that when it comes to a bearish market, again, that is a market that's going down, a falling market. A bearish market consists of lower highs and lower low, where each low is lower than the previous low and where each high is lower than the previous high. Now, the next thing we're going to talk about is for the bearish market. Throw that in there. Okay. Let's put that for the bearish market. The next thing we're going to talk about is where do we look to take our trade and what kind of trade, what kind of entry are we looking to take? Okay. Now, with a bearish market, that is giving you lower highs and lower lows. You look for selling entries only. Okay. Selling entries only. Okay. So a downtrend market or a selling market, you look for selling entry points. You want to ask yourself the next question: where am I exactly looking for this selling entry points? At what point am I looking for them? Where does the market go to give me these points? Right? Very simple. So when it comes to entry points, when it comes to entry, you look to enter trade and you look to enter your trade at a lower high. So a bearish market is a selling market that gives you lower lows, okay, and lower highs, okay. You look to enter at a lower high so you could go down with the market, okay. Now, the next question you want to ask yourself is, okay, if doing a downtrend or a bearish market, I am looking to enter in the market for a sell at a lower high, where is my stop loss going to be? Doing a downtrend, you get lower lows and lower high. When it comes to stop loss placement, you always want to use the previous high. The market itself broke the previous lower low point to give you a new low point. When it goes back to retest that point and give you a bearish PA, a bearish price action to be more specific, to give you a bearish engulfing that indicate buyers are no longer controlling the market. Sellers have now taken control of the market. You enter here and you target for the stop loss, of course, right? You look at the previous high to place your stop loss. Okay. Again, I'm going to go over this in more detail. So these are the things you want to ask yourself when it comes to a bearish market. What does the trend consist of? Like structure. It will always be consist of lower lows and lower high. What kind of trade am I looking for? I'm looking for selling trades, selling entries only. Where am I looking to find these selling entries? Well, at a lower high, at the retracement, okay? At the retracement point to go down with it. And where am I looking to place my stop loss? At the previous low high. So we sell at the new low high. Stop loss goes at the previous low high. Now, what are we targeting? We're going to target the next low that the market is going to give us, right? So it did give us a lower low. We enter here. We're going to target the next low, or to be more specific, the last low, and for market to continue, maybe go down to give you a new lower low. Now, of course, We enter or trade in the 4-hour time frame, which is the H4. So the structure is going to be a little bit different. So based on the daily or the weekly or monthly time frame, we are looking to target the previous low or low that the market gives us to go up. All right. We take that to come back down. Very simple. Okay. So now let's take a look at some different examples of downtrend with entries. So the first one is textbook, right? Where you have a very clean, beautiful, bearish market, like so. Market falls, goes up. Okay. This textbook, clean structures, textbook, clean structures. All right. You're going to find me repeating this over and over because I want you to understand. I don't want you to just know. I need you to understand this. Okay. Now, this is a downtrend. We're going to mark our lower lows. Okay. Also, a little cheat sheet when it comes to a bearish market or a falling market. Okay. Your lower lows are always going to be at the bottom. Your lower highs are always going to be at the top. Okay. So lower lows, where each low is lower than the previous low, where each low is lower than the previous low, where each low is lower than the previous low. Okay. Now we're going to identify our high points, which is the lower high. Okay. Up here, we have a low high and then another low high. This lower high is lower than the previous one. Another lower high. Each low high is lower than the previous one. Lower high, lower than the previous one. Lower than the previous one. Now, one thing I also want to throw out there. After, okay, let's collapse this real quick. You know what? Yeah. Boom. So after every lower lows, you are looking for the market to give you a low high, okay? After each lower high, you are looking for the market to give you a new lower low. And after each lower low, you are looking for the market to give you a lower high. So I'm saying this in different ways because everybody learned different. I want to make sure you guys understand that, okay? It helps out a lot, especially when it comes to understanding trend and how to take your trade. Now, with that being said, one more time, we look to enter a trade at lower highs, okay? Stop loss is placed at the previous low high, okay? Also, our entry is at the new ones. So when market give you a new low high point, it has to give you a bearish engulfing price action, indicating it's going to fall after it came back to bounce, right? That's where you take your entry. These are entries, okay, to come back down. Now, let's continue with this real quick. Now, here are the different variations of a downtrend structure you might get. We already seen the perfect textbook one. Sometimes we get structures that looks like this, where the market gives you a low, goes right back up, comes back towards it, and then goes higher, and then to give you that new low point. Okay. And then sometimes it'll bounce. See that? It'll give you a double bottom, go right back, and then to fall. Okay. As long as you understand that you are looking at the market in a higher time frame, is gonna help you stay in line with the overall trend of the market. That way you don't get confused. Always remember, market is most likely going to retrace or retest after it breaks. Once it breaks a previous low point, lower low, it will go back to retest it. Once it breaks, you look for it to go back to retest it. Okay. Now, when it comes to a trend reversal, a downtrend again consists of lower lows and lower high. Market for the market itself to be a bearish and then to become a bullish market, a previous high got to be broken. To be more specific, a lower high has to be broken. So when you're looking for a trend reversal, so a bearish market transition into a bullish market, a previous low high have to be broken. What I mean by that is market have to do like so, where it goes above the previous lower high, right? Once market goes above the previous low high and then come back down like so. Let's do gray. To come back down like so. So here, market has to give us a price action, of course, a bearish price action, a bearish engulfing to be specific, to fall back down. Now, it doesn't validate the trend reversal is complete. That's just the first part. Market has to break a previous lower high. Once it break the previous lower high, we have the previous structure point like these right here for the market to bounce off to, or it could come right back down to the zone. Now, it is still a downtrend market, but due to the fact that it broke the previous lower high, once market stops either at this zone or this zone, and then give us a bullish, okay, price action, a bullish engulfing, then we will take the buy to go to the upside, right? To validate the continuation of the trend reversal. At this point, right here, at this point here, this one is considered as a higher high. Why? It's very simple. Because market broke the previous lower high to give you a higher high. When the market came back to this point, either if it did stop here or down here, okay? If it stops at the same low point where this lower low, this will be still, this right will still be considered as a lower low, okay? Because it's the same zone, okay? Now, if the market did stop, let's do this real quick. If the market had stopped here or a little bit below, and then to go up, meaning give you that bullish engulfing here, give you a bullish engulfing right there, like so. Bullish candle engulf the previous one. You enter here to go up. Now, at this point, this will be considered as a higher low because market is no longer giving you lower lows. Okay. That right there will be a trend reversal. Now, again, this is a perfect downtrend that transition to a bullish trend. Okay. Now, let's go over some different entries and how the structure might look like when you look to take a break and retest for a sell, right? So, sell entries, structure, market stops, goes, boom. We're gonna mark our zone here because that's where the market stopped at. We just mark in this area. Market falls, breaks previous low point. Okay. Here. That's a lower low. Now we have a low high. When the market itself goes back to point, sometimes this is what it might do. Okay. It will go and hit. And to give us a price action, a lot of time it will consolidate. Okay. Into a channel. It doesn't mean that your sell is not valid. As long as you took your bearish PA, price action, and your stop loss is placed at the previous low high, you have nothing to worry about. Okay. Eventually, market will go where it's supposed to go to give you that lower low. Okay. Now, let's go ahead and look at a different aspect of it of when market would naturally go up, right? How it might go up. Same zone. Okay. Same zone. And here is market going up. Okay. Sometimes it will give you a wedge. It will go up, give you your price action, right? And then it will continue like so. You see that? It's giving you a wedge. It's still respecting the zone. It's just not falling as fast as you would like it to go. But the same concept stays the same or remain the same. As long as you are taking your bearish engulfing for what it is and placing your stop loss where it belongs, you should be just fine. Sometimes we get a wedge that is going up. Okay. When the market is going up, right? It'll hit zone, come back down, go back. You will notice that each low is getting smaller and smaller. This doesn't mean that your sell is not valid. Normally, market is just collecting. What I mean by collecting is people are changing their minds thinking that market is going to buy. And then once it goes down, they're going to change their mind again, close their trade and take a sell. This setup is still the same until market fall like it's supposed to. Just respect the overall trend for what it is and just take it for what it is. Okay. Simple break and retest with a downtrend. And that's what we look for. So other entries that we look for. Now, this is a downtrend with infrastructures, meaning where it's not as clean as you think it would be, but market is falling like it's supposed to. Okay. I'm showing you this to help you understand that it's not always going to be textbook. Now, this is a point where your fib could also come in, just like before. I just want to throw that in there. Just for the Fibonacci lessons. When you place in a fib for a sale, you always want to start at your low highs and you are targeting the previous lower low, right? So you start here, you're looking at the previous lower low, right? And then you are looking to take your trade at the next low high. So your fib will go something like this, right? It's a point. See that? To point, this is your zone. Normally, the previous lower low is normally going to be a 50% level, but sometimes market can go a little bit higher into a 60%. Okay. That's why our fib level is always 50, 60 to 61.8, and anything higher. I don't go anything lower than that. Okay. So here, market will retrace. So you could take our trade. Now, this is pretty much how market will look like again in a lower time frame, giving you all this small infrastructures as it falls and as it buys. But when you step back and look at the market in the higher time frame, as far as the monthly or the weekly, you see clean weekly bearish candles, clean daily bearish candles. Okay. Because altogether, this could just be 1 month. All right. But even if this was not 1 month, you will see a much clearer, a much better structure for the market. One of the things I want to go over also is, where is it? A double top that hits more than once. Okay. So in the downtrend market, you'll get double tops. Now, notice that again, like before, market is giving you lower lows and lower high. Sometimes it will go past the previous low point to go back to the previous low high. At this point, again, we are still in a selling market. This high has to be broken and retest for us to get a trend reversal. Okay. But we still in the selling market. When the market comes back to this point, we have a double header. What do I mean by that? Market went to this point, stops, and it falls, and it goes back to the same point for we looking for it to fall, right? That's why we call this a double top. Okay, market is at a specific point where it was there before. Now it's at the same level twice. That's what a double top is, right? So doing a downtrend, you do get a double top. Again, all you're waiting for is your selling, okay, PA, your selling price action. And that should always be the bearish engulfing price action. Okay. So it should always be your bearish engulfing price action. Okay. It should always be that. I think I'm missing an L, but you guys get the gist of it. It should always be a bearish engulfing. So let me just draw the textbook bearish engulfing. Okay. Bearish candle, candles. Okay. So market is falling. And let's do bullish candles going up like so. Okay. Here. Okay. Notice how this candle right here closed below the previous one. So it closed below this right here. So your entry point would be exactly right here. And of course, this you'll be looking for here. And then your SL, aka your stop loss, will be placed up there. Okay. So doing a downtrend, you will get a double top. That's pretty much when market breaks a previous lower low. Instead of respecting the 50% or 61, it goes right back to 100% from where it previously give you a lower high to match it. Now, when market falls, this is one. So this is the same lower high. Okay. It becomes the same lower high. Again, when you enter here for your entry, for your trade, for the sale, you targeting the previous lower low, and of course, hopefully it breaks through it. Okay. Now, I don't want you guys to look at this low point and just assume that it's going to buy. Okay. That's one of the lessons that I want to tap into. So this is zones, downtrend zones. Okay. I want to put a little bit more in there. This is downtrend zones. When I teach, I don't teach supplies and demands. I don't teach support and resistance, but every now and then I'll use that terminology for those of you guys that's used to it. But every one of my students, I teach them to understand that a zone is just a zone. Okay? A zone is created a zone is created by a price action, okay? Zone is created by a price action either to fall down or to go up. At every turnaround point, there is a price action. Now, when it comes to the lower lows, I'm repeating the same thing. I want to make sure you guys understand that, okay? When it comes to the lower lows, market had to give us a bullish engulfing, okay? Where the bull candle closed above the last bearish candle and you would enter to go up. So you get this here. Now, at a low high, excuse me, at a lower high, the price action we are going to get is going to be a bearish engulfing. That's when your bearish candle engulf the previous bullish candle. You take that to come back down. Okay. So at every turnaround point is a price action. At every turnaround point is a zone. So every turnaround point is a zone. And that zone area is also considered as a price action area because market had to give you an engulfing, a bullish engulfing or a bearish engulfing to reverse. So at every PA, okay, at every price action, okay, at every price action is a zone, okay? At every price action is a zone, just a zone, either if it's on top of it or at the bottom of it. Now, the reason why I'm saying that is because, take a look at this, right? If this is the zone and the market is falling, right? The market is falling and it landed at that zone. It's just a zone. Because it's just a zone, your job is to just simply wait to read and react. If I say, hey, this is a support zone, if I say this is a support zone, right off the bat, you're going to think buy. I don't want you to think that. The only thing you need to think about is it's just a zone. My job is to simply read and react to what the market is giving me, right? If you go based off, oh man, it is a support zone, I have to buy it. Now you're gonna have a one mindset. You just gonna be so stuck on buying the market when the market was in a downtrend. It was a selling market. It just happened to hit a zone. Please remember, right? Please remember that as the market falls, right, it give you a lower low to give you a lower high, right? Before market goes back to break the previous low point, it has to go and hit the previous low to give you a new lower low. If you assume it's going to buy every single time, or if you just have that single mindset, oh, double bottom, I'm going to buy it, you're going to get cooked. Because a trend reversal is when the previous high is broken. Now, I'm not saying that market can't buy here to go up. That's why we have double bottoms. But if you just treat a zone for what it is, see it as just a zone, your chances of being successful is going to be a lot higher because you you are respecting the market for what it is. You simply just wait for the market to give you a bullish engulfing to go up, then you will take that buy off that major zone. You see that? By just simply waiting for it. But if you're thinking of it like, oh man, we are now at a support zone. Oh yeah, I'm looking for a buy, I'm looking for a buy. And then you start dropping to lower time frame, you sabotaging yourself. You're taking yourself away from the bigger picture when you could have just simply just wait for it. Okay. That's why I don't teach support or resistance, supply or demand. Okay. Treat the zone for what it is. It's just a zone. Okay. So just like if I were to get a double top, right? Like we did before, right? Downtrend. We get a double top, right? A DT. That's when the market goes and hit a specific area that it did before. This is just a zone. I don't want you to think, oh man, this is a resistance zone. I have to sell it. This is just a zone because a lot of time, right, market will go towards that zone, right? It'll go to that zone and the last bullish candle will just close either above or exactly at point, and you will drop down to the lesser time frame because in the bigger picture is just one candle. When you drop to the lower time frame, there's a lot of small infrastructure going on. You might get a trend reversal on a lesser time frame, but that's just the lower time frame. Okay. You have a whole day for the market to play out. Now you in the 1 minute or the 5 minute trying to get an early entry because you're thinking that it's going to buy or it's going to sell without waiting for that 4 hour bearish engulfing. Okay. So what I'm saying is you need to simply wait for the market to give you that bearish engulfing. This is not a buying zone. It is not a selling zone until you have a price action to confirm that the sell is valid. Now, of course, market can always go above. Let me make it cleaner, okay? Let's create a small little breakout. Close above it. Let's be more clear with this. This is still going to be a seller market, okay? Candle close above, then you get a bearish candle like so. Notice it and engulf it. You have to wait for it. And then sometimes you will get I hate it when it happens, but it does. You will get a bullish candle, right? That either engulf or sit exactly at that point. You buy it just for it to come back to give you that bearish engulf and to continue down. All right. This is what I mean by simply reading and reacting. Also, when you use the 4 hour to take your trade, it's really, really hard to overtrade. The only thing that is the easiest for you to do is to over leverage, but it's really, really hard to overtrade, especially if you're just taking one trade. It's a 4 hour price action. It took 4 hours to be completed. So you don't have to check it until 4 hours later. When you in the 1 minute or the 5 minute, you're going in and out, in and out. Okay. You don't want to do that. Make your life easier. Just take that price action for what it is in a 4 hour time frame, put your stop loss where it needs to be, and just come back and look at it 4 hours later. There's a lot you can do in 4 hours. Hit the gym, cook, clean, take a nap, read, play some chess, whatever you want to do. Okay. So just simply treat a zone for what it is because it's just a zone. When you start naming it, you're going to start giving it some identity. You're going to make it something that it's not. Your job is to be one with the market, not to tell the market what to do. I used to do that. I got barbecue chicken. Ugh, tough times. But yeah, please don't do that, okay? Um, I don't want to extend this video for too long, but I'm gonna see you guys on the next video. As always, thank you for the love. Thank you for the comment. Thank you for the subscription. Okay. Thank you for the like. Thank you for the share. If you haven't, please give me a like or a share. I will truly, truly appreciate it. Go ahead and comment on go ahead and give me any comments that you like as far as anything that you want me to go over. I'll go over that for you. Starting next week, I am going to be going over different pairs to show you how the engulfing work for every single pair. The only difference is some pairs are more expensive than the others. So with the AU, it's a lot cheaper. With the GJ, it's more expensive. Gold, a lot more expensive, but it's the same system. It works for every single pair. Okay. From Bitcoins to the USD. All right. With that being said, peace out. I'm going to see you guys in the next video.